Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is January 21st, 2025. We're here today with the great, world-renowned econ professor, Ed Burton. Thank you, Professor, for being here.
Glad to be here, Hunter.
Professor, Davos is happening. As we sit here, Ray Dalio predicted that the UK is in a debt spiral. If they're in a debt spiral, where are we? The U.S. debt is $36 trillion, heading to $50 trillion. Federal revenue is a little less than $5 trillion. Are we in a spiral, and how do we get out of it?
Well, this is what I think Ray may have meant. Ray Dalio and I, strangely enough, worked together many years ago at Smith Barney, long before he discovered he wanted to start off with Bridgewater. But back in the day, he was a broker at Smith Barney. I think what Ray means by that is that once you get to a certain debt level, it requires ever-increasing interest rates to fund that debt. And the United Kingdom's been facing that. So have we, by the way. Certainly in the intermediate-term debt and long-term debt, rates have been going up quite a bit. And I think his concern is, as those rates go up, they feed an increase in the debt, especially if the primary fiscal situation's out of balance, which it is in the UK and which it is in the United States as well. So I think he sees higher interest rates fueling higher debt levels, fueling higher interest rates, and that's what we mean by a spiral. It just continues to spiral up. So what ultimately happens if that takes place is the central bank will be called upon to buy the debt and to try to keep those rates from spiking, but as we all know, that leads to inflation, and then ultimately you get even higher rates. So there's no easy way out of that. Eventually you'll have a stagnant economy that just sort of grinds to a halt. But the system can't work with that kind of change in the value of the currency taking place, and there's no limit to what would happen in that case. That's the disaster scenario, and that's what Dalio is talking about. He's talking about the possibility that you reach a point where there's simply no turning it around. You've got too much debt, rates are going up faster and faster, and debt's going up faster and faster with it.
Professor, unfortunately, the UK pound is not a reserve currency. The US dollar is a reserve currency. For our listeners, what is a reserve currency?
A reserve currency is what countries tend to hold for the purpose of settling balance of payments differences. So if you're doing a lot of buying and selling in a multitude of currencies, some in the euro, some in this and that, different currencies, and say the Chinese yen or the Japanese yen, if you look at all that, when you go to settle, settlements are typically done in the U.S. dollar. Everything gets converted to the dollar, so people want to hold the dollar so they can do international settlements. So you'll find many countries holding substantial amounts of the dollar. There's always a demand for it. Sometimes people ask, well, why don't Japan and China sell their treasury holdings? Well, part of their treasury holdings are to have that reserve currency, to hold that for dollar settlements. So it's the kind of the currency of the world is maybe another way to put it. In other words, they reserve it for the purpose of international payments. So as long as the dollar is a reserve currency, it's felt that the debt spiral possibilities are not as high for the U.S., but they are really. You can go from being a reserve currency to not being a reserve currency pretty quick. And there are plenty of other choices for people as far as currencies. There are a number of stable currencies around the world. The yen, for example, Chinese yen, is an example, and the euro is another. So I don't know that we don't face essentially the same thing that Dalio is suggesting could be happening in the UK. And I don't know if we're at that point yet or not. But that is the fear, that you'll reach the point, and when you reach the point, you don't know you've reached the point. That's the real danger. And then you think somehow the central bank can keep that from happening, and they can't. There's nothing the central bank can do other than run the digital printing press, and if they do that, then the spiral continues just by a different mechanism. Inflation will drive rates higher, which then drives the debt higher, which then drives rates further higher as well.
So how do you break the spiral?
Well, you can't without an economy that just completely falls apart. It's kind of akin to the black hole in physics. The gravitational force grinds everything into a point, and then the game is over. The economy will not fare well, even with moderate inflation. If inflation in the U.S. starts looking like inflation in Argentina or Turkey, the U.S. economy will really become a mess. You need stable interest rates. You need reasonably stable prices to have a strong economy. And you won't have that if that happens. And that's a real danger.
Two ways out would be strong growth or massive reduction in spending, two possibilities that are not likely. The U.S. government's running annual deficit a little less than $2 trillion. What's our next step, Professor?
Well, I think those numbers can get a lot worse quickly. If you have a recession, for example, and we haven't had one in a while, but if the economy slows down, taxes fall much quicker than spending. In fact, often spending doesn't fall at all when taxes fall. And that means that deficit gets larger, and it could get much larger. It can go from $2 trillion to $3 trillion or $3.5 trillion, and it can do that quickly. It can do that in 6 months or 7 months, something like that. So there's a danger that if the economy weakens at some point, and sooner or later it will, the economy won't forever grow at a 2+ growth rate. And when it does weaken, then the deficit gets worse. And you may not have what you usually have when the economy weakens is rates start falling. That might not happen this time around because of the debt situation. So you may have the worst of all worlds with an economy that falls into recession, but you don't get low rates to help pull you out of that recession. I think that's likely to happen. I would rate that as an odds-on possibility that you end up with economic weakness down the road, and when it happens, the deficit widens and the debt goes up even faster.
Professor, our new president has suggested that he's thinking of imposing 25% tariffs on Canada and Mexico. Tariffs good for the U.S. consumer, bad for the consumer?
Well, I think tariffs are never really good for anybody, but that doesn't mean a tariff policy is necessarily always wrong. It could be right under some circumstances. For example, the so-called national security issue has been brought up to defend some of the tariffs. Although I think the industries they're talking about, it's not clear that they involve national security, but maybe they do, maybe they don't. But tariffs inevitably raise the price of whatever you put the tariff on. There's no question about that. Now, there's some discussion by the administration that doesn't happen, but you can't hide the fact that if you restrict supply, that's going to have an upward movement in the price. So the question is, why do you do it? What's the point here? Well, part of it is the long frustration about the decline in American manufacturing. That's been a big issue. And those of us who live in the South are familiar with the fact that the textile industry and furniture industry, which used to dominate parts of Virginia and North Carolina and some parts of South Carolina, disappeared when we opened trade with China. China could produce textiles and furniture a lot cheaper than we could and put most of the Southeast areas out of business. And then even when you go back further, when Japan got into the auto business seriously, everybody discovered Hondas and Toyotas. That put a crimp in the dominance of the U.S. auto industry. And it's been a tough sledding for the steel industry because of the competition from Japan. That's one reason the recent acquisition effort by Nippon Steel to buy U.S. Steel met so much political opposition because Japan has supplanted the U.S. as essentially the most efficient steel makers in the world these days. And so that's been a concern by lots of folks in the so-called Rust Belt and Midwest, as well as the Southeast, and probably has had a political impact in recent years in some of these elections we've had. But anytime one country trades with another, whatever you're importing is going to hurt your domestic producers. I don't care what it is. If you're importing oil from abroad, that's not in the best interest of your domestic oil producers. If you're importing cars from abroad, that's not in the best interest of your auto producers. So the argument that some sector of the economy is getting hurt will always take place. There's no way to trade one country with another without hurting some section of each country. That's just what happens. So you can go to a policy of no trade at all, just have, tariffs that rule out much trade, or you can take some steps to help transition people who are in an industry that can't compete. So what do we do? Do we try to prop up U.S. steel some way? Do we prop up industries that really can't compete? Or should we go the other way? We're dominant forces in lots of areas of the world, particularly in the tech world. We're a dominant factor in the AI, for example, and in all the hardware that goes along with AI. And we're dominant in a lot of other things as well. But that's what happens when you trade. You end up specializing in some things, and some things just kind of go away. And that's happened to every country. In the 19th century, England dominated the world with a policy of no tariffs. They had free trade, and that meant a lot of things in England kind of disappeared, and they imported it from other countries. And the people that used to make that in England were upset. But it worked for both countries. And I think the benefit of trade with China over the last 2 or 3 decades is that China has made a lot of goods very cheap that we could not make so cheap. And these things came through at Walmart and through Amazon and through a lot of different retailing things and brought low-price, high-quality product to the average American. Take something simple like the iPhone. The iPhone now costs, depending on which one you buy, between $1,000 and $1,400 for a new iPhone. But it would probably cost twice that if you didn't produce it in Shenzhen or India or somewhere. If you produced it in Detroit, you'd be spending $3,000 for your iPhone. So some people are benefiting. Trade works that way, but it has a distributional side effect that people don't like, and that can lead to, particularly those who lose their jobs or the industry is displaced, things that for generations they've been in that industry, and now that industry is going away because you're buying your cars from Japan or Germany or China or somewhere else, but that's what happens with trade. Now, the interesting thing is, within a country like the U.S., that's happening every day. In other words, some industries that might work in Louisiana work better in Texas. So Texas gets all the business and Louisiana loses it to Texas. And you don't hear a big hue and cry about that because people can move. But with countries, people cannot easily move. The auto workers in Detroit can't move to Tokyo to work in the auto industry. So all these same effects we're talking about happen within a country. They happen within the U.S. There are areas that are good at producing oil and other areas that aren't very good at producing oil. And so the areas that are good at it take over the oil industry, and the areas that aren't good at it leave that industry. So tariffs are a complicated issue, but if we get in a situation where tariffs become common and countries decide where they're going to use tariffs to protect domestic industries, and that becomes a global phenomenon, that's going to slow world economic growth. There's no question about it. We have benefited from international trade. Now, some groups within America have not benefited. Lots of folks lost their jobs and so forth. But there may be better solutions to how to deal with that than simply not having trade at all. So I think the tariff issue is complicated. I think tariffs are, in general, a bad idea. I think they reduce the national wealth, but I can understand why they become a political issue.
The data points are crystal clear. The U.S. is in financial trouble. Unfortunately, the timing of that real pain is predicated to a significant degree on interest rates. Federal Reserve meets next week to set the federal funds target rate. The yield on the 1-month U.S. Treasury today is 4.31%. What will the Fed do next week?
Fed will do nothing. The current target range is 4.25 to a half. That 4.31 is sitting right inside that target range. They don't move the target range if the current T-bill yields are inside that target range, and they are. So look for the Fed to do nothing. I don't think they'll, unless there's a big move in the T-bills between now and then, and I don't think there will be. So the Fed will do nothing in January, and then we'll take a look. Based on where the Treasury bill market is and what other rates are, it's about equally likely they're going to raise the target range as they might lower it. You might see T-bill yields start picking up, and if that happens, all of a sudden the Fed would raise the target range. So the Fed's kind of in a quandary. What Powell would love to do would be to lower rates, but that's not really in his power. Unless he can somehow talk the Treasury bill yields down below 4.25, he can't do it. He's wanted to do it, there's no question. He signaled 4 or 5 months ago that he was going to lower rates. Everyone had 4 rate cuts baked into the cake for 2025. Now people have 1, maybe 2 at most in the forecast, and that's because the Treasury bill market went where it wanted to go. Treasury bill market doesn't listen to Jerome Powell, and it does whatever it wants to do. And that's essentially what it's done.
Have you ever seen the potential calamity in economics that we have today?
Well, it's hard to forecast that we're going to have a calamity and when, but what we're doing now cannot end well unless we take some dramatic steps to do something about it. And I've never felt, at least not since the 1970s, that the upward pressure on rates is as heavy as it is now. And we had much lower debt numbers then, much lower debt as a percentage of GDP. On the other hand, if you watch the markets, we're at all-time highs in the stock market. There's a tremendous enthusiasm. We just inaugurated a new president yesterday. There's just lots of enthusiasm in the marketplace, but I'm concerned. I would personally flash the caution signal here, both for the economy and for the markets as well. There are problems ahead, I think.
Professor, big week. We'll meet again soon to talk about interest rates. Thank you.
Thank you, Hunter. Always a pleasure.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.